Coming up in today's show, stocks finished the day lower as bond yields continue to rise, along with oil and gold, and Tesla earnings come in short. Hey, what's up guys? You're tuned in to the Click Capital Daily Market Show, and another interesting day on Wall Street. Bit of bearish breadth across the board, with a bit of weakness out there in the semiconductors, software stocks, financials, and even few of the mega cap techs came off, including Tesla down almost 5% in the regular session and trading down lower again after hours as I speak on the back of their earnings report. And stick with me because I'll get into that one a bit later on. The only real winner today was energy, oil and gas on the back of a strong crude price. And we saw a little bit of a bounce back in some of those consumer staple stocks that have been hit really hard of late. Okay, so first a quick update on the Middle East situation. I'm sure you all heard that horrible news of the hospital bombing. We're just getting reports in now that it may not have been as bad as initially thought. And with US intelligence concluding that it wasn't Israel that did the strike on the hospital, but rather a misfired rocket from Hamas militants. However, as you can imagine, that's caused a lot of outrage for supporters of Palestinians, including Iran, which is reportedly calling for an Israel oil embargo. That is for other countries to stop sending oil to Israel and try and cut them off. So tensions are still building over there. We've only seen a little bit of skirmish fighting between Hezbollah and the Israelis, and it's still very much possible that Iran give the green light to Hezbollah to go ahead with a full-scale attack, which would take this conflict to a whole new level and send oil above $100 a barrel. And that's why we got the Biden administration going over there to try and cool things down. They've encouraged the Israelis to allow humanitarian aid into the Gaza Strip to try and appease both sides. And once again, Biden's going all out, saying he's going to ask Congress for an unprecedented support package for Israel's defense, with potentially up to $100 billion, and which seems like a lot just to help Israel, an already capable military force, attacking a really small militant group in the Gaza Strip. So it looks like the Biden administration and the US military is trying to deter a spillover with Iran, but could be also getting ready for that possibility as well. And so not only do we have a strong bid in the oil market, we also do in the gold market as well, as the usual safe haven of treasuries are in a record drawdown, so that leaves the very few areas like gold as one place to hide out throughout all this mess. And so even though we've had a strong US dollar of late with those higher yields, with gold move up again today, reaching $1,975 an ounce on pretty good volume as well. And after that weak initial reaction back here when Hamas first went into Israel, it seems like the market is getting a bit more nervous with the situation over there. However, the price action in crude oil futures has been a bit more subdued. We are coiling up around the 50-day here. But like I've been saying, the tail risk still remains, and oil could easily spike up above $95 a barrel should Hezbollah start attacking Israel at full scale, because then we might see the US military ships currently sitting in the Mediterranean Sea potentially join in. So the US Treasury held a big auction today for 20-year bonds. Actually went pretty well, showing there's still big demand there, and with the rates offered coming in as expected. However, the back on that strong retails data we got out yesterday, yields are still moving higher, causing the rout in bond and fixed income ETFs to go even deeper in the red, and we can see that with popular ETF TLT hitting the lowest prices today we've seen since 2007, but on big volume and bit of a technical divergence here, so the market's trying to find a bottom here in these really deeply oversold levels. However, for that to happen, we need to see yields top out, and there's the US 10-year yield approaching the big 5% mark we've been talking about for a while now. I think it's attracted to that level like a fly to a light, and we could very well hit that tomorrow, if not going into the weekend. And that's what probably upset stocks here a bit today, with S&P 500 falling 1.3%. Similar move lower in the Nasdaq, with mid caps and small caps hit even harder, down over 2%. And so even though bond yields are hitting 16-year highs, a few analysts are saying don't expect them to fall anytime soon, as there's some pretty big changes needed for that to happen. We'd have to see a significant weakening in the economy, which we haven't been seeing. The economy's holding up pretty well. Same with unemployment. And typically the bond market gets a bit ahead of the Fed, and most hiking cycles have usually end with a 10-year yield at or above the policy rate. And so currently the 10-year is at 4.9% with the Fed funds rate still at 5.25. So looking back in history, that would indicate that we're not at the peak of this cycle just yet. And if history is any guide, the recession when it happens is likely to be deeper than the consensus expects, but it's also likely to be a surprise. But that pain is already well and truly here in the real estate market, especially for people trying to get in for the first time, with the interest rate in the most popular American home loan hitting 8% for the first time since 2000. Very much similar story in other Western markets of Canada, UK and Australia. That's why we've seen activity in the real estate sector plummet to multi-decade lows. However, due to the lack of supply, that's helping to prop up prices for the time being. But we've got some like billionaire bond investor Jeffrey Gunlock saying now's the time to buy long-dated treasuries, with prices set to rebound going into a recession. He expects a downturn to hit in the first half of 2024. Also saying mortgage-backed and commercial bonds are attractive at current levels. He said we like long-term treasury bonds for the short-term trade going into a recession. The 30-year US treasury yield downtrend of the past 4 decades has completely reversed, skyrocketing nearly 400 basis points in under 2 years. And there's a long-term chart of what he's referring to, the 30-year government bond yield, and we can see that in a solid downtrend since 1987 when it was above 10%, and there is where it bottomed in COVID at 0.7%. And so that's the biggest rally we've seen in long-dated bond yields over the last 40 years. Similar story in the 10-year yield, after it peaked above 15% in 1981, over 40 years ago, and that's been part of what's fueled the everything bubble since then, with a secular bull market in bonds and stocks. However, that's all changed over the last couple of years now. But just looking at the monthly chart of S&P 500, after initially selling off last year due to the rise in inflation and rates, had a really good bounce back this year, and the stock market's held up a lot better than we all expected. However, like this article says here, interest rates and stocks are both up, and this can't last. One of them has to come down, as this trend contrasts sharply with history. And like this analyst says here, tech valuations are very high and inconsistent with a significant rise in long-term interest rates. In short, something has to give. Either stocks have to go down to be consistent with the current level of interest rates, or long-term interest rates have to go down to be consistent with the current level of stock prices. And so the market, and not even the Fed, knows where interest rates are going to go and whether they're done or not. With us here summing it up pretty well, too soon to tell if the economy will cool or prices heat up. We could go into that second wave, 70s style higher inflation, or we could get a nasty surprise and those rates really start causing some economic damage. But now the Fed can wait and watch just to see how everything unfolds, with the market doing much of the job for them. And we'll get to hear from the big kahuna himself, with Fed Chair Jay Powell set to deliver a speech tomorrow. We'll expect him to echo the higher for longer sentiment, with him probably trying to stay on the fence and remain as neutral as possible again, leaving the window open for another hike and saying they're very data dependent and wanting to see more signs of inflation coming down before they can officially announce they're going on hold and potentially drop rates again. Also out today was the big one. Earnings from Tesla coming in a bit lower than expected as their price cuts this year are starting to eat into their profits, sending their profit down 44% in the third quarter. Even though revenue was still up 9%, it's a definite slowing of growth we've seen over the last couple of years. And their operating margin came in a lot lower as well for the third quarter, 7.6%, well down from their 17.2% in the year prior. Also squeezing their margins was higher operating costs associated with some projects, including the delayed Cybertruck, which they're hoping to begin delivering on November 30. And going forward into next year, that could help them get back to higher growth, and we'll just have to wait and see what the margins are like on that new product. But they reaffirmed their goal of delivering 1.8 million vehicles this year. That's up from 1.3 million last year. And their deliveries for the third quarter are up 26% year over year. And we also saw the other big trend this year of the other big automakers latching on to Tesla's supercharger network to run their cars as well. And we could see a similar thing with their FSD, full self-driving technology. And the Cybertruck could prove to be really popular, a first of its kind. And just looking at the price action in Tesla, we actually came off 4.8% in the regular session, just down another 3.5% post-market as I speak, as they did miss a bit on estimates, reporting earnings per share of 66 cents versus 72 that was expected, and a touch lower on revenue as well. So next area for support for Tesla will be around that 235, 240 level, and we'll see whether it can hold that. Otherwise, we'll be looking down to around the 210, 215 level as the next area of support. Also hit hard today was financial stocks after having a good day yesterday. We had Morgan Stanley report with their profits decreasing year over year, upsetting the market a bit, reporting $1.38 in earnings per share. That was down from $1.53 for the same quarter a year ago. Market didn't like that, sold them off almost 7% today, which made the whole sector do a bit of a reversal, finishing the day down almost 2% as well. Over to economic data, we got China's GDP yesterday, coming in a little bit better than expected, 4.9%, and what could be a signs of a little bit of a rebound in their economy. It's got inflation data out of the UK coming in a little hotter than expected. Their core inflation still really high compared to other Western economies at 6.1%. Eurozone inflation came in line at 4.3%. Then we got some housing data from the States, which was a bit mixed, coming mostly in line as expected. And the amount of crude oil inventory coming in a bit lower than expected as well, which didn't really seem to get the price of oil moving much higher. Looking out to later on today, we've got some unemployment data coming out from Australia, into tomorrow, weekly jobless claims, and a few Fed speakers we'll be looking at. Fed Fund Futures still saying there's a good chance the Fed may hike again at some point in the next couple of months. Will be dependent on the next CPIs we get, and still not much action from corporate insiders. It was a really busy day in the options market for a Wednesday, 43 million contracts traded, and something a bit different from late. Huge amount of puts, 54%. We also had earnings out today from Procter & Gamble, coming in a bit better than expected, 6% on EPS beat. Market liked that, up 2.5%, and just got earnings after close on Netflix as I speak. They also coming in a bit better than expected, 6.9%. Markets liking that, we're up 12.4% after hours on a bit of a dead cat bounce, as Netflix have been sold off pretty hard this last couple of months. Just looking at international stock indices, they also had a bit of a turn down this Wednesday. There's China closing down to new lows in this entire cycle, and the other indices kind of just holding up, turning off their 50s a bit. Got a bit of a jump in the volatility index today, getting over 20, finishing at 19.2. And volatility still holding up there as well, showing that volatility pricing's moving around a bit. Same with volatility risk premium at 5.7, and a bit of a sharp turn down and breadth, 42% of stocks above their 20-day average. And the trend continues with the amount of stocks hitting new lows versus new highs. More pronounced on the Nasdaq, 133 new lows to 17 new highs today. And a little bit of a turn down the growth versus defensive sector spread, now back below its 50-day, and even more so in high beta stocks versus low volatility stocks, and growth versus value coming back down to the 50. But overall, small caps still really weak versus large caps. And there's gold versus treasuries once again ripping higher as the safe haven trade, along with inflation expectations still ticking up there. And we can see that in the 2-year yield as well, now at 5.22%, sitting near highs, which is causing weakness even in high yield bonds now, breaking down to multi-month lows after it'd been in that range pretty much all year. And that's not a good sign for risk assets either. Those strong yields are helping to keep the dollar up there, 106.3. There's Bitcoin consolidating at 28,000, and the commodity complex as a whole holding up pretty good here. Over to stock sectors, mostly red out there. Cannabis ETF initially started off the day pretty good, making up to multi-week highs, but then turned around and finished today quite a bit lower at 8%, as the safer banking legislation is still up in the air, and with everything going on in Congress with the new House Speaker, market's really not sure what's going to happen here. There's the AI bots ETF, falling over 3% today, finding new multi-month lows. Same with overvalued stocks that ARK holds. Clean energy still weak, and home builders in a strong short-term downtrend, finding new lows as well. Along with the airline companies, had another rough day, down 4.3% after we got earnings from United yesterday. And once again, the standouts, energy, oil and gas finishing the day higher, almost back to new highs. Biotech breaking down again, along with transports and the interest rate sensitive REITs. Got a little bit of a bounce back in the staples, but utilities kind of stalling out there at the 50. BlackRock Barometer taking a bit of a dive as well. JP Morgan giving back all of its earnings gap, and the big guys, Apple, Microsoft, Google and Amazon, a little soft. NVDA fell again after we got that news report yesterday, the Biden administration banning exports of advanced chips to China. Quick look at Tesla, have fallen even more after hours, now down 4.4%, and the rest of the tech pack was all pretty much weak today as well. Along with the sea of red and meme stocks, there's Birkenstock falling 2% today, and there's that little bit of a bounce back in the snack makers today, with a bit of pullback in the other ones. Next era, General Motors, a reversal on Walgreens, which I'm not entirely sure why it fell so much. Today I need to do a bit more research on that one. Some of the others as well, 3M and Sphere Entertainment pulled back, along with the telecoms finishing a bit weaker, and the regional banks as well as the big guys, and even Charles Schwab, which had a good response to its earnings, did a bit of a pullback today, down 3.5%. So as we can see in a lot of those charts, there were some vicious downturns today and reversals. A lot of the sectors breaking out to multi-week, multi-month lows, and some pretty volatile moves down in a number of stocks as well, tech and old economy. So it's a lot worse than what it looks like on the main chart here of the S&P 500. And we can see that in the equal weight S&P 500 and the Russell 2000 as well, in a bit of a strong short-term, potentially going into a medium-term downtrend here. These main indices now testing the support they've been trying to develop over the last couple of weeks, and we've actually got micro caps actually breaking down through that support. With volatility waking back up, now flirting with 20, and the market a little bit nervous with the key tail risk. The Middle East conflict spills over and we see a spike up in crude. Even if that doesn't happen, we've still got government bond yields ripping higher on this really strong momentum that could still go into a blow-off top above 5% on the 10-year. Either scenario is not good for stocks, but really need to see the conflict in the Middle East cool down, yields pull back, and Q3 earnings come in better than expected to get stocks really excited here. Otherwise, I say there's a good chance we break down through this trend line we've had since October last year, and that could change the tune of the market a bit as well. That's all for today. Thanks very much for tuning in to Click Capital, and I hope to see you again tomorrow afternoon. Cheers.